One of the things I love about One Rental at a Time, frankly, I hope you appreciate, is the wide variation of voices and experience. On Monday morning, we speak with Taylor from Life Goal Investments, who spent 12 years on Wall Street, giving us unique insight into what is going on in the markets. Today, we're going to talk about gold. I don't know if you've seen the stats, but apparently since 2020, gold has doubled. In the S&P 500, it's up about 80%. So gold is outperforming. If you go back even farther, it looks like gold is outperforming Warren Buffett, I've heard. So this is kind of crazy. What the heck, Taylor? What is going on with gold? Why is it ripping? It's up over $100 today. I just checked. So is gold trying to tell us something?
Yeah, I think its messaging is pretty clear right now. That little yellow metal typically works in three environments. So if you think about the economic cycle as four environments of growth, inflation, stagflation. Stagflation obviously being when you have high inflation coupled with slowing economic growth, and then recession on the other side. So gold is a great diversifier for a portfolio because, typically stocks, what people own most of, do well during growth, but they struggle in those latter three camps. And that's where gold works out really, really well traditionally. And gold is delivering a message right now that we are in my opinion, what gold is telling us is we are potentially entering a stagflationary environment. And I can tell you why. I told you that it works in inflation, stagflation, and recession. I can tell you why other assets are potentially saying something else about inflation and recession. So why it might not be saying that, but stagflation fits all the parameters that we're seeing right now.
Yeah, I certainly believe in it. Thankfully, on this channel, we've been talking about stagflation being a real risk. It's gone from a sub 10% chance a year or two ago to some people would call it the base case for 2025.
Every economist right now is saying slower growth this year and higher inflation by the end of the year. So is the Fed.
Well, remember when Jerome Powell said, "I don't see the stag or the inflation"?
And we laughed at him immediately. And we were like, well, I'm not sure what you're looking at.
Because it's here, buddy, the stag and deflation. It's funny because when I look at gold, I know the history, I know the experience. I actually think it's telling us something else. I don't think gold is currently telling us anything about the economy. Okay. I agree with you. When you look at historically, there are these cycles. I believe what is going on right now is outside forces, so ex-US, are looking at what's going on in Trump's presidency and basically saying, we want less of that. I believe it's very clear that U.S. assets are being sold off, whether that's treasuries or stocks or even real estate. I'm seeing foreign owners of real estate like Canada, I read about over the weekend, listing. Yeah. Currency.
The currency as well.
Yeah, weakening. So I actually think what's going on is this is a vote of no confidence. Yeah. That's what I think gold is telling us. I also read the other day that China added 5 tons of gold to their physical storage. I expect India to do something similar. So I think what's going on is a huge vote of no confidence, but maybe I'm wrong.
No, I think that's a fair assertion. I look at things through the economic lens, but you look at things more on kind of the narrative lens, which is totally fair. And it doesn't mean they're mutually exclusive.
No.
When you look at this shift to gold, a lot of it started with the Russian-Ukrainian war. And what started taking place there was the U.S. basically froze all Russian assets that were in U.S. treasuries. And U.S. treasuries were that large liquid safe haven that everyone felt confident in, where they could park their assets, garner a modest yield, and always have liquidity and the backing of the U.S. government that is so sound and economically, sturdy. And then you had the U.S. say, we're not doing that anymore. We're going to freeze Russian assets. We're not going to pay their debt. We're not going to pay the interest rates on the debt, et cetera. And so you started to have broad foreign governments start to step back and say, whoa, is this actually the entity that we thought it was? Is this actually a safe haven for our assets? And I do think that gold was a natural replacement at that point. So you're not off.
Yeah. When I look at this picture, again, as somebody who spent time on Wall Street, you see big money flows. You're behind the curtain a lot more than anybody else on my channel that I know. And when I think about a vote of no confidence on U.S. assets, all of them, that doesn't mean the dollar supremacy is dead. But what it means is we might see, again, a country like Japan, and I'm going to make up these numbers, where when they look at their, investments, maybe 60% of it was US dollar denominated assets, and
Yep.
40% was rest of world, for
Yep.
example.
Yep.
If all the countries out there go, you know what, I'm going to take my US exposure down 10%, only 10%, that's going to be hugely disruptive, because when you're the biggest, marketplace, and you have, all these other sellers at the same time, and that's what I think is going on, it only leads to lower prices. And I think that's exactly what's going on. The US dollar's down, treasuries are down, rates are up, and I think it's only getting worse. This is a doom loop we could be in.
Yeah, and it's funny because you're right, where the typical correlations and relationships between things have just come apart right now.
They're
Usually, if you see
broken.
that totally, usually if you see stocks selling off, what you're going to do is get a rally in bonds on the other side. But I think a lot of what you're saying here comes back to just this geopolitical battle that we're in right now with foreign countries. And when tariffs were our weapon of mass destruction on them to say, hey, we're going to create upheaval in your economy because the US buyer that's the biggest consumer in the world is not going to buy it anymore because we're going to, force the prices to be too high. They said, all right, screw it. We'll dump your currency on the market. We'll dump your bonds on the market. Bond rates will shock higher and your currency sells off. That typically is not the correlation that takes place, but that's what's taking place. And I will provide one piece of context here. We are coming from a position of massive US dollar strength over the past few years. So the dollar had rallied meaningfully versus every foreign currency, essentially, if you draw a line against it, the US dollar rallied meaningfully. So we are coming from a position of strong dollar, but it is weakened in very, very rapid order.
Yeah, again, the weakening of the dollar really doesn't bother me looking at the macro picture. What bothers me is these correlations that have been
Correct.
destroyed. I think the biggest one, and the one that sends shivers down my spine, is the fact that the 10-year is up in rate and the
Yeah.
dollar is weaker.
Yeah.
That occurs very occasionally for very short windows of time because of some outside event. We're on to like week 3 of this.
Yeah.
This is now a trend. This ain't no blip.
Yeah. I don't have a crystal ball. Let me be very clear on that. I do think that we'll get some reprieve in rates. I think that at the end of the day, it's hard to make the argument, even with all of this debauchery that's taking place right now, that the US is not the most sound economic backdrop that someone could land their assets and be confident that they're going to actually be there. And so I think you will get buying of the US Treasury that brings rates down. I know that's counter trend right now and counter.
But hold on. So I love that story. I again think that is historically accurate.
Mhm.
But if you agree, which I think you did momentarily or a minute ago, that all outside US forces are going to cut back on some allocation, where does that buying come from? Does the Fed, I guess the Fed has to step in. Does the Fed grow its balance sheet again?
Yeah, I think at some point also the rates just become so attractive relative to foreign rates that
So they
people
go up
step
to
in and
some rate, and then
yeah. And then what happens is the momentum takes place. I agree. Listen, that's not, but we might be there. That's what I'm saying is we might be there at that attractive rate relative to, I mean, if you look at our country and say and this is, I know because of the narrative in the market right now, this is going to sound silly, but do you look at any other country in the world right now and say, I'd rather park my assets there and feel safe about them than the United States?
it's not, that's the wrong question. That is the wrong question.
Is it?
The question is, do I deposit the same amount I used to?
Oh, okay.
I
Fair.
used to
That's
see
fair.
that's
fair.
that's the rub that nobody's talking about. Hey, I used to routinely give 60% of our invested capital to the US. Now I'm going to give 52.
Yep.
That 8% delta is the problem.
It is just very, very hard to peel apart 200 years of correlation very quickly and say that if we get a weakening economy, rates don't come down. It's just, that's very,
I
very hard to start to kind of grapple and wrap my head around. But
well,
again, in short order, correlations do come apart. You had correlations come apart during COVID. Bond
absolutely.
rates
Yeah.
ripped higher and bonds got eviscerated in very short order. And you're like, wait, but that was a massive economic slowdown. Why would that ever happen? So, that's the forced liquidity. So it's not just international buyers now balking. It's hedge funds trying to create liquidity as they get squeezed out of their short positions. And so what they're doing there is they're not always just covering a short a short Apple position or something like that, or a long Apple position that's losing money, they're not necessarily doing that they're levered to. They're
Right.
looking for what's liquid in their book, and they're purging it. So there's a confluence of events that's coming together right now that's making this nasty, and I think probably overdone. I could be wrong.
Yeah. Well, again, neither of us have a crystal ball, but again, we've started this video talking about gold. I think it was like 3,400. I checked this morning before the open.
Yep.
Does this thing just get, I mean, do we get, here's a question. Do you think we see 4,000 in 2025?
I don't claim to be a absolute gold expert, but I guess I'll take it back to my original part of the conversation. When you have bonds selling off, bonds don't sell off during a recession, right? So bonds are saying the opposite of a recession, and there's a lot of moving factors, right? So every economist on the street saying recession, but bonds are saying that that might not be the case, and we might have more pressure on pricing going higher. And so that's if we were just going into a proper recession where you have slowing economy, prices typically will come down, bonds will go up in value. Well, right now, bonds are not going up in value in the last 3 weeks. They're going down in value. And so that begs the question of inflationary pressures. And I think that's what gold is telling you, is that gold is holding up well because people don't trust bonds. They don't trust the inflationary trajectory moving forward. The Fed is telling them inflation's going higher. Every CEO is telling them inflation's going higher. Every economist. And therefore, the safest asset I don't know if we're going into an inflationary environment, recessionary environment. Those are the two pressures I'm scared of. Gold.
You know what? I love to make calls. I'm wrong all the time. I don't have a crystal ball, but one thing I know about consumers and momentum is once it gets started, it's hard to stop. So if we're jumping $100 a day, I don't see why we don't hit 4,000. The other thing we know about consumers is asset prices rise. They actually take people off the sidelines. The whole buy high, sell low phenomenon, because investors are wild. They don't buy low. They actually buy high. So I don't know why gold doesn't see 4,000 in 2025. I am not a gold bug by any stretch, but momentum is momentum.
Wouldn't shock me. And what you hadn't seen until earlier this year is, even though gold has been marching higher for 2 years in a row now, you had not seen retail buyers jump on the gold trade. Now you're getting retail buyers.
It's coming. You're going to see it on the front page of Fortune and Forbes and this and that. Gold's outperformed the S&P 500 since 2020, folks. That's going to get people's attention. And guess what? The average investor does. They buy at the top.
Chase, baby. Chase.
Taylor, where can people find you?
Yeah, find us at Life Goal Investments. We're on Instagram. We're on TikTok. That's our handle. And we'll keep you updated.
There you go. Thanks, buddy.
Thank you.